Okay, Chapter 9 of Cost Accounting, we're going to talk about activity-based costing, or ABC, they'll abbreviate it. So the first few slides are showing like how do we look at these numbers and these financials to make a decision. So the company's looking at these two products that they make and they're thinking, I think we should get rid of the S72s, possibly because the costs are too high per unit. However, when we look at our overhead, so let me flip back there, you can see that included in those costs are $96,000 in manufacturing overhead. So then as we look at how is that allocated out if we were only to do, so this is how it initially is on the prior slide, what if we only did the S66s? So we see like utilities go down, supplies go down, training. Supervision does not go down though, because we probably do not have a separate supervisor for that product. We've got the same guy who we still have to pay to supervise the whole manufacturing area. The same with the machine. We're not going to probably get rid of a machine, and we have the plant that we're operating in. We're not going to get rid of the plant. So we still have those depreciations to cover. Miscellaneous could go down. In this case, they have it not going down. So the only thing really that goes down is utility, supplies, and training. Everything else stays the same. So then we see if we get rid of that and we put it in, and we put all of that overhead over into the S66s, now all of a sudden their costs are going to increase. So they go from 1,125 up to 1,450. So then maybe that's not such a good idea without analyzing what's going on with the sales of that product. So here it calls it the death spiral. So like if we think, okay, this product's not making us money, we're going to pull it off the line, and then we focus only on the one product, but then the costs go up, then we're going to want to increase the price because we're going to think, well, we still got to make our markup. So then you end up increasing the price. Well, then people find it somewhere else cheaper, and then you lose sales, and then it ends up costing the company more money than if they had just kept that one product. So even though that one product isn't making a ton of money, it's absorbing some of the costs. So our two-stage allocation. The first stage is we allocate overhead costs to departments, and then we allocate the department cost to products. So we don't start with a product, we start with the departments. So here we have, again, our direct materials and our direct labor obviously go right to the products. So we're focused on the overhead side. So now we're going to say our overhead, we've got machine-related costs and direct labor costs, and then those are going to be allocated to whatever products we're making, again, based on their usage of machine hours or their usage of the direct labor costs. So then here we've got the detail between two different products, Sport and Pro. We've got our direct labor and our direct materials all mapped out. And then we have overhead costs, assembly, and packaging that we would need to then allocate. So we are going to allocate that, our total overhead, we're going to divide it by our total direct labor hours, if that's what we're using as our allocation base. So then that gives us 90%. So then 90% of the direct labor costs are going to get allocated to the sport and then to the pro. Okay, when we have two-stage, then we're going to say, okay, well, it's assembly and packaging. So the assembly is going to be based on a machine hour, and then the packaging is going to be based on the percent of direct labor costs. So we're just trying to make it more detailed and really apply it to who uses what. So then now you can see we're applying it based on the machine hours for the sport pro for the sport and the pro, and then the packaging again based on the direct labor. So our plant-wide allocation method, there's just one set to allocate to all of the departments. The department allocation, we create a cost pool for each department. And sometimes, again, that's going to be more accurate when there's one product that is used more heavily in one department than another. So again, if we have similar products using all the same resources, all the same departments, plant-wide allocation probably isn't going to make, it's going to be fine. If we have multiple products that maybe don't use the resources at the same level, so maybe the one uses the assembly, but the packing's super easy. The other one has, maybe way more assembly, and they're both packaged equally. I mean, if it's something like that, we're going to want to separate those. So again, like we said, we first assign the cost to the activity, and then we assign the cost to the products based on their usage of that activity. So we want to identify the activities that consume resources, identify what their cost driver is, compute the rate per cost driver, and then apply it to the products based on how they've consumed it. So if we have these 4 different activities or departments, what would be those identified cost drivers? So we're going to have it per setup hour for the setting up the machine, per production run for the handling of the materials, machine hours for the machining, and then production runs for the packaging and the shipping. So then we would calculate out 4 different rates, and then we would apply them to the product based on how they used them. So then here again is a big kind of cost hierarchy, giving you some examples. So if it's volume related, we may be applying supplies, lubricating oils, machine repairs, and then what could drive the supplies and the machine repairs. We could have your direct labor costs, your machine hours, your number of units produced. Those could be examples of cost drivers. If it's batch related, we'll have a setup cost for that batch, material handling, shipping. So then the cost drivers could be setup hours, production runs, number of shipments. Product related costs could be compliance cost, design and specification costs, and those would probably all relate to the number of the products. Facility related, general plant costs, plant administration costs, and those could be direct costs or value added costs. So normally if the problems are going to identify what those cost drivers are, but in the real world, you'd want to kind of figure out, well, what do we think it is? Labor, machine hour per product, what kind of seems the best. So we're back to the sport and the pro. Again, we still have all the direct costs, and we're allocating out our assembly and our packaging. So now our assembly, it's going to be setting up machines, handling material and product assembly. Our packaging is inspecting, packaging, packing, and shipping. So then we're going to look at the assembly to say, okay, machine hours, how many machine hours did each one use? And then we'll allocate those costs out accordingly. Setup hours, how many hours were involved in a setup, and we'll allocate those out. Production runs, the inspecting is our direct labor hours, and then our shipping is our number of shipments. So then we calculate out a cost driver rate for each one of those cost drivers. And then, so again, we take our total divided by the total cost driver. So that'd be the 2 of them added together to get to that rate. Then we apply it. So then we apply it to each one of the, again, using those rates we just calculated. We look at the quantities, multiply those out to get to our totals. So these would all be good ones. Like if you're good at Excel, kind of setting some of these up in Excel, because you could really kind of go column by column with those, because they all tie out, to get to these totals. And then again, here just is trying to show you that diagram about how these different activities are within this assembly building. These different activities are within the packaging building. And then these are the activity cost drivers. So then there it is all put together, and we come down and we can get to our unit cost, our unit cost per product. But again, it just maps out all those totals by product and then divides it by the number of units that are produced. So then now it kind of sums it all together to say, okay, this is if the costs if we did the plant-wide rate. This is if we did it by building, assembly versus the packaging and shipping. And then this is if we did it by activity. So I guess probably the activity is the most exact, but then the department rate isn't that much different. It's pretty much different than the plant rate though. So the overly generic one ends up hurting the sport a little bit more than it should. So, but again, the activity-based is going to be harder to keep track of. So there's more cost involved. So maybe like in this case, the department rate might be the best one because it'd be a little less. Then they like to show you kind of how these all move through our general ledger, through the T accounts. So again, our materials are going to go into our work in process as they are issued out. We would have a separate work in process for each product. Our labor is going to go out of our wages payable and into the work in process, again, for each product. Our overhead is going to go into each product. And again, more, coming in, going into each product. Oops, I'm sorry, let me go back. So this is going from one department to the next department. So then our work in process, we have an assembly work in process, and then we have a packaging work in process. So we have to assemble it first, and then it moves into packaging, and then from packaging, it would go to finished goods. Okay. And as companies become more automated, their direct labor is going down and down. So if they're using direct labor, it can sometimes disproportionate how it's going to go. In most productions, it's very machine usage. The machines are very computerized. So machine hours might be the better way to go if you're a high-tech company. If we're doing activity-based costing to services and not products, we still basically go through the same steps. Identify the activities that consume the resources, identify what the cost driver is with that activity, compute a rate per cost driver, and then apply it to the service. So again, like what I was just saying, why would you not use ABC? Because it definitely seems more detailed and like you're going to get more accurate numbers. It may be too costly. There's a lot of reporting that would go along with that. So maybe the costs are going to exceed the benefits. But there would be a risk, again, that we're going to overcharge one product over another if we are using the very simplified methods. So there's also a modified approach called the time-driven activity-based costing, where we're looking at the time it takes to complete the activities within that department and then allocate costs that way.